So I know a lot of you guys watching this right now might be new investors who just started, or you might be somebody who's looking to get started but hasn't started yet. If you're somebody who's already started investing, then you might be panicking a little bit right now because maybe you just invested recently and you've seen your account drop by a lot. Or if you're somebody who hasn't started yet, maybe you're wondering if now is a great time to start buying investments. So I have a little panic indicator that I invented for myself that I check. And the way it works is I go to the grocery store and check if they have toilet paper in stock. If they do, then we're all good, nothing to worry about. And if they don't, well, but I'm sure they will. I'm sure there's nothing to worry about at all. So it's time to panic! Okay, that was a joke. Everybody chill, it's not time to panic. I think it's really funny how crazy people get over toilet paper. Like, how much toilet paper do you use on a regular basis? Like a roll a day? A pack of toilet paper is gonna last you a while. I understand like canned food and soap, but anyway, I've had a lot of new investors reach out to me with questions about what's going on right now, and I can divide those new investors into two different groups. One group is panicking and wondering if they should sell all their investments and what the heck's gonna happen, and the other group is people who are frothing at the mouth, wondering if now is a great time to start investing or if it's a great time to be buying investments. Well, today is going to be a very important video for you all because I'm going to talk about 5 things that'll apply to both of those groups of people and will help you get through this economic situation that we're experiencing right now. The first thing that you need to do is to stay calm. Keep a cool head. Emotions are the #1 thing that is going to part you from your money. Just look at what emotions are doing to people right now about things like toilet paper, even though it isn't really logical. What are you doing?
I need to make sure I can wipe my bum.
The exact same thing is happening in the stock market right now. If you saw my last video talking about the Dow Jones headlines, then you'll know that the media is purposely trying to incite fear right now. And that's not saying that you shouldn't take this seriously, you definitely should, but they're looking to incite emotions out of you to get clicks because that's how they make money. So you need to be very critical of the information and the news that you're consuming right now, especially when it comes to investing. There's actually a really cool chart I want to show you to kind of put this all into perspective. Okay, so what I wanted to show you here is a chart that goes back in time. And what we're looking at is the bull markets versus the bear markets throughout history in the US stock market. So if you look at from about 2010 to 2018, which is where this chart ends, you can see that we've been in a bull market for a long period of time. And if you extended this out into 2020, you would see that we've been in a bull market for almost 12 years. So looking at this chart, you might think that maybe we're due for a bear market based on the timeline here that bear markets seem to be experienced throughout history. And now we look like we are actually in one as of March. So it makes sense based on the timing that we've seen throughout history. And that's because markets have cycles. They go through cycles of upturns and they go through cycles of downturns. But here's something really important to keep in mind. The average bull market has lasted 9.1 years and on average returned about 476% to investors. And now bear markets, on the other hand, they last only 1.5 years on average. So they're very short, but they strike very hard. And the average cumulative loss is about 41% per bear market. So losing about 41% in only 1.5 years, that's a lot. That's very fast, that's very quick. They usually come out of nowhere and catch people off guard. So while bear markets can seem extremely scary when they're happening, and a lot of people think the stock market's going to zero, they're actually relatively short-lived compared to the bull markets that follow bear markets. So the main takeaway here is that this is the nature of investing. So if you're new to it, welcome to the party. It's, I guess, either fortunate or unfortunate, depending on how you look at it, that you started investing now, but this is the nature of it. The market is going to experience events like this throughout your lifetime, and overall, the trend is most likely going to be upwards, but there's going to be some bumps along the way, and some are bigger and scarier than others. But you'll have to be able to get through them if you want to invest in the stock market. This is really important. Every day I see people ask how they can get the best return on their money for the next 1 or 2 years, or even how they should invest their down payment. Stop. Do not do this. This is how you get burned. The problem with investing money for the short term in the stock market is because of, well, things exactly like this. Imagine that you're saving up $50,000 for a down payment on your home and you invested in the stock market. And this was the year that you were looking to take that money out. But now you can only take out maybe like $25,000. Bye-bye, house. Money that you need in the next 5 to 10 years should be put in a safe place like a high interest savings account. Yeah, you're not gonna earn a heck of a lot of money on it, but that's not the point. The point is to keep it safe. If you need to save up $50,000 for a down payment, then save $50,000. Don't save up $25,000 and hope to turn that into $50,000. That's not a good financial plan. If you are wanting to invest your money, it ideally needs to be money that you don't need for the next 10 years at least. And that's because the longer you have your money invested for, the statistics are going to be on your side that that's going to be a positive investment. And that's because bear markets tend to last for about 1.5 years on average, as we saw from that chart. So that means if you're investing for 10 years, then you still have 8.5 years, statistically speaking, where there should be positive gains. And the farther you go out in time and the longer you invest your money for, the statistics continually move more in your favor. So that's why it's important to not invest this money for stuff you need in the short term. But also, you'll want to consider something that's very important relative to your timeline, and that's your risk tolerance. For a lot of new or young investors, this will be the first true test of what you can actually stomach in the stock market. I know a lot of people, when they first start investing, are thinking, yeah, no problem, I can take a 50% drop. I'm not gonna bat an eye at it. And then when it does actually happen, it's a lot different than what they actually thought in their head it would be like. So this is your first real test to see what you can stomach. When I was first learning about investing, I didn't exactly know what I was doing. When I was younger, I made a lot of dumb mistakes. So I took some big losses, and those were basically educational for me because it got me used to the idea of losing money and what that is like. But I'd like to save you that experience if I can, so that you don't have to lose money in reality. Instead, you'd ideally figure out beforehand what your actual risk tolerance is and adjust accordingly. But there's also, nothing wrong with now if you do realize that you are somebody who gets really emotionally affected by your investments and you're having trouble sleeping at night, there's nothing wrong with reevaluating your risk tolerance, taking another look at it, saying, hey, maybe I shouldn't be as much invested in stocks. Maybe I should increase the proportion of bonds in my portfolio. Because at the end of the day, mental health is more important than money. So what I would recommend is checking out the video I did on how to evaluate your risk tolerance. And also there's a lot of great questionnaires out there, like the one that Vanguard provides, where you can answer questions and it will tell you what your risk tolerance might be. I'll put a link to that in the description below. Figuring out your risk tolerance means determining what level of risk you need to take on to meet your financial goals. But you also need to pair this with what level of risk that you are actually comfortable with. And perhaps exceptionally important right now is also considering how stable your income is. If your job is at risk because of the economic difficulties that we're going to face because of the situation we're in right now, then you need to take that into account for what it means for your investments. And whether or not your job is at risk, financial times like these really call for an often neglected aspect of personal finance, the emergency fund. Do you have an emergency fund? If not, now is the perfect time to make sure you do. And that's because an emergency fund can mean the difference between being able to make ends meet versus having to go into debt to get by. Personally, I always make sure that I have at least 6 months worth of living expenses put into a high interest savings account that I can access easily. It makes me feel extremely comfortable knowing that in any event where I lost all sources of income, that I would be okay for the next 6 months and be able to support myself. And here's what people usually forget. An emergency fund like this should really be set up before you begin investing. This comes before you consider putting your money at risk. And that's because an emergency fund is the exact type of thing that will allow you to sleep at night through financial crises, because you'll know that you're going to be okay for months out into the future because of this money you have in a safe place. Trust me, an emergency fund is a way more powerful financial tool than investing your first few thousands of dollars. So if you're thinking about investing but you don't have an emergency fund in place yet, stop. Build your emergency fund, and then once that's complete, then revisit your intention to invest and make sure it's with money that you don't need for the next 5 to 10 years. Having a plan for your finances is absolutely essential. If you're winging it right now, you might be being led around by your emotions. Having a financial plan is like having an anchor for when times get crazy. You have something to hold on to and remind yourself that you made that plan when you were in a sane state of mind, especially for situations where poop hits the fan. And trust me, poop is all over the fan right now. If you watch the Tale of Three Traders video I did, then you'll know that simply investing your money on a regular basis, even just the same amount, dollar cost averaging your money into the market and not even touching that plan, is the best way to invest your money for the long term. It's the best way for the best of times, and it's the best way for the worst of times. If this was your plan before we had the markets crash, don't stop now. Continue your plan. One thing you can do to completely take yourself out of the equation and remove whatever errors might be caused by your emotions is to set up an automatic contribution to your investments on a regular basis, and then just walk away. There's actually a funny story I once read about an older person who, I think they lost their password to their brokerage account, and over the next like 40 plus years or something like that, their money just sat in this account that they didn't have access to, and then ultimately that person ended up passing away. And when they did, their family members found out that that person had millions of dollars in that account that just grew because that person didn't touch it. So it grew through all those economic crises and just continued on growing through time. It completely removed the possibility of any human error. Now, I don't know if that was actually a true story or not, or if it was kind of just like an investing proverb basically, but the lesson is definitely valid. An unmanaged investment will perform better than a managed investment over the long term, the vast majority of the time. So also an important thing I wanted to address today is that there is a lot of new people here who have joined the channel, so I just wanted to say welcome, and I'm so happy to have you here. I'm going to be doing my very best to share ways that we can get through this economic situation together. I truly and strongly believe that everyone has the ability and the right to understand their money, and I'm trying to do my small part to make that happen. And so with all that being said, I'm Steve Antonioni, and this has been Cash College on investing in a market downturn. Stay calm and stay safe.